Today, we are diving into the personal and business uses of life insurance, specifically for the national portion of the life insurance exam. One of the most common concepts you will see on the test is survivor protection, which focuses on providing the necessary funds for dependents to maintain their standard of living after the primary breadwinner passes away. You need to distinguish this from estate conservation, where the goal is specifically to use the death benefit to pay off inheritance taxes and federal estate taxes, so that the actual assets, like a family farm or a private business, do not have to be liquidated to satisfy the taxman. A favorite exam trap involves mortgage protection, where the examiners will often ask which type of policy is best suited for this purpose, and the answer is typically a decreasing term policy because the face amount drops in line with the remaining balance of the loan. To determine how much insurance a person needs, you must know the difference between the human life value approach and the needs approach. The human life value approach calculates the individual's future earnings and potential income, while the needs approach looks at specific financial obligations, such as an emergency fund, education funding, and final expenses. When we move into business applications, the key person insurance is a high-frequency topic. Remember that in a key person scenario, the business is the applicant, the policy owner, and the beneficiary, while the employee is the insured. The exam will definitely try to trick you by saying the premiums are tax-deductible for the business, but they are actually not deductible, although the death benefit is received tax-free. Another critical area is the buy-sell agreement, specifically the difference between a cross-purchase plan and an entity plan. In a cross-purchase plan, the partners buy policies on each other, while in an entity plan, the business itself buys the policies. You might see a math question asking how many policies are needed for a cross-purchase plan among 4 partners, and you should use the formula of the number of partners multiplied by that number minus 1, which in this case would be 4 times 3, or 12 total policies. For executive bonus plans, also known as Section 162 plans, keep in mind that the employer pays the premium as a bonus to the employee, and because this is considered compensation, the employer can deduct the premium while the employee must report it as taxable income. To help you remember these core business uses, think of the mnemonic BEST, which stands for Buy-Sell Agreements, Executive Bonus Plans, Succession Planning, and Tax-Free Key Person Benefits. Another point of confusion is the distinction between liquidity and accumulation. Life insurance provides immediate liquidity through the death benefit to pay for final expenses like funeral costs and medical bills, whereas the cash value in a permanent policy represents accumulation for future needs like retirement. Be prepared for questions that ask which personal use involves creating an immediate estate, and the answer is always life insurance, because the full death benefit is available the moment the first premium is paid and the policy is issued. You should also watch out for the term blackout period, which refers to the time during which Social Security survivor benefits are not paid to a surviving spouse between the time the youngest child reaches age 16 and the spouse reaches age 60. Mastery of these specific terms and tax implications is the key to passing this section of the national exam.